Our next witness is Mr. J. Douglas Robinson. He's the chairman and CEO of Utica National Insurance Group in New Hartford, New York. Utica National is among the top 100 property casualty insurance organizations in the country. He's testifying on behalf of Property Casualty Insurers Association of America, which has over 1,000 members.
Chairwoman Velasquez, Ranking Member Graves, and members of the committee, thank you for the opportunity to testify. I am J. Douglas Robinson, Chairman and Chief Executive Officer of the Utica National Insurance Group, a group led by two mutual insurers headquartered near Utica, New York. Utica National provides coverages primarily for individual and commercial risks, with an emphasis on specialized markets including public and private schools, religious institutions, small contractors, and printers. My company markets its products through approximately 1,200 independent agents and brokers. Our 2008 direct written premiums was more than $632 million. I'm testifying today on behalf of the Property Casualty Insurance Association of America, which represents more than 1,000 U.S. insurers. PCI commends President Obama and Congress for working to ensure that the financial crisis we experienced last fall is never repeated. Achieving this goal requires a focus on fixing what went wrong with Wall Street without imposing substantial new one-size-fits-all regulatory burdens on Main Street, small businesses and activities that are not highly leveraged nor systemically risky. My company insures small businesses like bakeries, child care centers, auto service centers, and funeral homes. These Main Street businesses should not bear the burden of an economic crisis they did not create. Home, auto, and commercial insurers did not cause the financial crisis, are not systemically risky, and have strong and effective solvency and consumer protection regulation at the state level. We are predominantly a Main Street, not a Wall Street industry, with less concentration and more small business competition than other financial sectors. Property casualty insurers have not asked for government handouts. Our industry is stable and continues to provide critical services to local economies and communities. However, small insurers are concerned about being subject to administration proposals intended to address risky Wall Street banks and securities firms, but that apply broadly to the entire financial industry. Specifically, we're concerned about the following. The proposed Consumer Financial Protection Agency does not adequately exclude insurance from its scope. An exclusion should be added for credit, title, and mortgage insurance, which are generally provided by and to relatively small businesses. And protection should be added for insurance payment plans, which are already well regulated by state insurance departments. The proposed new Office of National Insurance is given too much subpoena and preemption power without adequate due process or limits on its scope and its ability to enter into international insurance agreements. It also needs a definition of small insurer to prevent excessive reporting requirements. Systemic risk regulation needs to be modified to reduce government backing of large firms at the expense of small financial providers. Leveraged Wall Street behemoths must be allowed to fail in an orderly manner, not made even bigger through government bailouts and consolidation. Government shouldn't forget or harm Main Street in addressing systemic risk regulation. Resolution costs of systemically risky firms should be paid for by firms with the greatest systemic risk. Bank regulators should not be allowed to resolve systemic risk failures by reaching into the assets of small insurance affiliates, whose losses would then get charged back to other innocent small competitors through state guarantee funds. Finally, congressionally proposed repeal of the McCarran-Ferguson Act would significantly reduce insurance competition, primarily harming smaller insurers that would not otherwise have access to loss data and uniform policy forms necessary to compete effectively, and that would ultimately harm consumers. The cost of new regulations almost always disproportionately affect small business, who can least afford the necessary legal and compliance requirements. The property casualty industry is healthy and competitive, and the current system of regulating the industry at the state level is working well. Should the Congress fail to address the issues we have identified, the consequences on consumers and the economy could be quite harsh, imposing an especially large burden on small insurers and small businesses. Thank you.